Thank you everyone for being here. It's obviously great to be here, especially when the LBMA basically pins the annual to the all-time high of gold price. So we have a ton of questions. It probably should be the top 10 client questions we're receiving at the moment, but we should go through. So just very quickly, who we are, who I am. Given the growth and the changes at MKS, these are all our sort of group companies at the moment. I'm with MKS PAMP, which is basically our financial and trading hub, as well as PAMP, which is all our products in our refinery. So, the macro backdrop and gold, it's a super interesting time, as Philippe pointed out. I think before I get into the questions, just wanted to talk about where we are at the moment. The graph shows your 2023 year-to-date performances across most macro assets. We talk about its wars, its recessions, which is basically driving haven demand. There has been huge underperformance in industrial metals, energy and industrial metals, which is basically telling us we're super late cycle, right? Like where recession is coming, it's just how deep and how quick. And you've got this outperformance in no real kind of synchronization, but this outperformance in sort of what I call like new age and traditional havens. So it's everything from your Swiss franc to gold, to Bitcoin, US tech, which, that separately is a different debate, but you put the price of gold against your Magnificent Seven US stocks, and the correlation is just super strong. So it's just, what's your definition of a haven? The interesting thing here is that we've had bonds haven't really participated in this overreach for havens, right? So they've extended their bear market losses from 2022, which goes to speak about the politics around the US and the US dollar. But all in, I think we're in a world where we're basically short of trust and we're short of havens, and that pool of havens is definitely shrinking. So, first of all, our top question we get is certainly around inflation and what is that dynamic with gold, because gold is that chameleon asset class that really kind of chops and changes when it suits itself. But we clearly have got a strong trend of disinflation this year across the Western world. But you got to look at it, and it comes down to real rates. So gold is a proxy for the Fed's ability to control inflation and or recession. So if you think either one is going to happen, you're decently bullish gold. The point here as well is, we're in it's like the last mile. Bringing inflation down from 10 to 5%, that's pretty, it's relatively simplistic. It's getting it down to target, which I think is going to be very interesting as we enter later into the cycle. And then what are the implications for gold? I think it's not a one-size-fits-all market. I think you look at inflation, let's look at Western demand. Certainly, if you got higher interest rates for longer, it's a headwind and we've seen the preview with consistent ETF outflows. You've got positive real rates. You can go and get risk-free. You can go risk-free into a U.S. government bond or into an investment-grade bond, and you're earning 5 to 10%. Why would you type capital in gold? But it's also a potential opportunity for emerging markets and certainly for central banks who actually see gold as an inflation hedge. Geopolitics, and again, these are what is gold's relationship with geopolitics, and this question really came up increasingly more the past 2 weeks, because we're basically talking about peace in the Middle East. I mean, not exactly peace, but you're talking about truces, you're talking about release of hostages. There certainly is diplomacy in the Middle East, and gold is taking aim at all-time highs. So really a disconnect there. But the graph shows just the series of high uncertainty floors, and you've got two ongoing wars. And what it means tactically for gold, I think you really have to decide whether gold is in a bull or bear market. Again, it means different things depending what market cycle you're in. Gold has this ability to sort of internalize the immeasurable. We talk about a cognitive warfare, like what exactly is that? And I think gold is then used as a proxy for some of these structural themes coming about. At the end of the day, war risk equals sanction risk equals de-dollarization. It's as simple as that. And I think that's where you get that sort of higher gold floor regime coming into play. So, de-dollarization, you can't say that word without mentioning central banks, and they certainly have been a huge participant in the gold space. The last year, record high central bank gold demand, and then again this year, they've bought 800 tons year to date, which is as of Q3, which is basically 3 times as much as what investors have sold. Yet, as of Q3, not as of today, as of Q3, gold prices were basically flat. And the model implied price action should have said we should have been up around 6%. So sure, we've caught up. So what has been the recent underperformance in Q3? I think that's producer-related selling, gold in various currencies at all-time highs. You're going to attract in physical selling, producer-related selling, and that sort of cap pricing. But the question is central bank demand is bullish, neutral, or bearish? For me, it structurally has been a higher floor. It's very, very supportive, and it's not yet bullish, but we're starting to see signs that it may become very bullish. The flip side of that is, sure, central bank demand, and we all report purchases, but I love this chart because it actually gives you perspective, and it's central bank holdings versus annual gold supply and ETF and COT holdings. So we sit and we microanalyze ETF and COT flows. Meanwhile, like central banks own 10 times as much as what ETF and COT own. It's, you can just as easily be sellers as you are buyers. This is not one directional. Metal always flows to where it's best treated. If the price says so, whether that's forward or outright, metal can come back to market. So I think, take it with a grain of salt. Central bank demand is certainly supportive and could be bullish. But if that drops off, it absolutely could be a bearish sort of development for the gold space. And so, yeah, wrapping up, it's, what is our forecast for 2024? And, given the last week, we're sort of scrambling to really just reassess if there's something new in the space, because gold really has moved, from that 1930 level in a straight line and then exploded higher on the Sunday night open to all-time highs and came back down. But all those structural forces are sort of coming to play. You have a backdrop where you're talking about gold is simply a proxy for Fed rate cuts and general unhappiness into late cycle. That's what we see. That is being accelerated. And so our forecast for this year was 1930. Our forecast for next year is higher floors is 2000, with a sort of range of 1850 to 2200. But again, that's base case. You can outline a very bullish case for gold if things just don't come together collectively and you get a sort of deceleration in the world economy. But then again, the flip side of that's our forecast, and this is, we're not bullish at any cost. There's certainly risks to the gold space, tactical risks and structural risks. And the chart is US real rates versus gold ETF holdings. And given that real rates are sitting at 2% plus positive 2%, and you're looking at the outflow of ETF holdings, it really should have been a lot lower. So, that's sort of the mind the gap that if we do have a higher for longer Fed, and if the Fed rates are still at 5% at the end of 2024, it's a very bearish development, because again, gold is pricing in basically rate cuts starting in Q1 next year. Obviously, if Asia physical demand disappoints, that's a bearish development. We talked about central banks monetizing gold. Any US dollar liquidity crunch, gold is a liquidity asset first and foremost. That would impact pricing. And then again, it's, the view certainly amongst, I would say, Western investors is that sometimes it's just a very expensive, costly to hold World War III hedge. And if geopolitics really sort of improves, then, I think some of that premium will be taken out. Structurally, gold has no direct role in the energy transition. It's not silver, it's not platinum. Yes, it it plays a role to the risks around the energy transition, such as inflation, or if we're going to war over copper in Africa or something. But there's no direct role, so that you can debate that. And then the sort of the old generational headwind for gold, and it's a fact now. It's been a fact 5 years ago, 100 years ago, and it just in a world where we are transitioning very, very quickly. You've got this massive wealth transference. 84 trillion is going to be moving from the silent and the baby boomer generation into the younger gen. What is gold's role in that world going forward? So to switch hats very quickly, and it's funny, gold's in the headlines for all-time highs, and PGMs are in the headlines because of supply cuts and because the prices are basically at very cyclical lows for two very different reasons, and we've not seen that in the precious space for I can't remember for quite some time. I've got 3 slides. I'm not quite 5 questions on the PGM space, but it's sort of PGM ZAR prices, which is the top panel, and basically that's a reflection of just how well the South African producer community is doing. There's a couple of takeaways. Clearly, the biggest question around the PGM space is, are there going to be supply cuts? How deep are they going to be? Will that actually impact pricing? You can see the cyclicality of that. It's you go from feast to famine very quickly, and there's certainly an argument around risk management from that side. But at the end of the day, historically, it's been proven that you really shouldn't bet on South African producers responding very quickly to the market. We've seen how they've been so resilient in the face of supply cut, power cut, and Eskom. So the idea is that they probably won't respond as quickly as the market would hope. But at the same time, we are seeing a ton of headlines around Section 89 notices, voluntary drop cuts. They're cutting gold production. So I do think it's not going to be a large drawdown in PGM supply, but I think it'll be persistent over this year. And at the end of the day, we can talk about South African platinum and PGM supply, which has certainly peaked in the short to medium term. The second panel is, what are the implications for obviously platinum and palladium, given that platinum and palladium are reaching parity at the moment, and that's mostly the legwork being done with palladium prices significantly lower, sitting at $1,000. I would argue that it's pretty tough to bet against palladium, given already what the shorts are doing and the fact that we're sitting with this threat of ongoing supply cuts from the sector. The saying is the best price for lower pricing is lower pricing, and palladium at $1,000 is very attractive for your OEMs and your autos to then re-thrift back into palladium over platinum, which they've been doing the last couple of years, and the technology's there. So rhodium and palladium probably have the highest delta to a recovery that's better than expected, and South African production cuts. And so it's a little dangerous being short those unless you really think we're going through a hard landing. Here I've just sort of outlined your near and medium term drivers in the space. Platinum, it's all macro for the most part, and it's about what we've been ping pong between 900 and 1100, really kind of dependent on CTN investment demand, and again, like the growing substitution risk, which is now going to be reversing given parity. Palladium tactically remains oversold, but you've got this persistent threat over given the threat from EV demand and expected recycling, which is meant to come. And then rhodium, I think, is if there's one precious metal that's really indicative that we're so close to recession, it's the rhodium price collapsing. It's the most industrial of them all. I think it's also very indicative of the higher interest rates and the destocking that has occurred in the industry, and we do think it's nearer the end than the beginning. So again, rhodium is super sensitive to South African supply and to any kind of slowing of the EV penetration rate or just the upping of ICE auto sales. The consensus for platinum and palladium is that it's like almost overly simplified. It's platinum sat for years in structural surpluses and now should be moving into structural deficits, and palladium is sort of the opposite, has been in structural deficits and moving into structural surpluses, and the sort of stepsisters from that in that regard. But consensus always scares me if you put on your trader hat, because it never really goes according to plan. The fact that you're going to be getting supply cuts into late cycle, into some sort of recession, and then we're going to get demand picking up. And you kind of see the parallels with what happened in the energy and in coal and energy space, where and again, it's part of being commodities, where you get this mismatch between supply and demand, given sort of the macro implications. In terms of forecasting, we have a pretty neutral palladium outlook. It's at 1,000. Again, if you have a hard landing, I think it can certainly halve again, but that's not our base case. And then platinum, neutral to slightly more bullish, because I do think if you're a gold investor and you've missed this last $200 move, you have to look at the space and what are the other high beta precious proxies, and that's silver and platinum. So platinum, we have 1,100 for next year, but again, I think their upside comes post in the recovery phase. So to summarize, just some of our very broad macro themes and how that translates through a precious metals lens. Huge fan of this. It's just, what are the big general themes we've come from the past decade, and where we're going to into this decade. And these aren't going to happen simultaneously. It's not going to be linear, but we're moving from a growth sort of deflation regime where we had a very globalized world, and now we're talking about inflation, like it's higher interest rates. We talk about fiscal excess. We talk about a world of war, where we have a very visible policy hand where commodities are increasingly more weaponized. So to summarize, and it's not in order, but some of our sort of themes to think about. So the top is sort of your more tactical themes, and I think the last two panels are sort of a little more structural in nature, but talk about a short US dollar and the fact that the thinking there is like the Fed is done. The market, Powell came out and he said they may still hike, and the market just completely ignored that last week. If you saw the price action, the Fed is done. It's just how many rate cuts we get. This talk of a U.S. exceptionalism being behind us. Talk about modern politics, and you certainly talked about it a lot. But it's Trump 2.0, a messy election campaign, and sort of for us the best expression for short U.S. dollar is your sort of high beta gold proxies, silver, platinum, copper. Long volatility, again, it's headline and policy risk is driving markets at the moment. If we do have a higher for longer and QT does extend, that certainly is vol injecting. And then again, it's this market there's growing skepticism around the central banks and their ability to either bring inflation down or the ability to prop markets up. And so your best proxy for that, we think, being long, low volatility, safe haven currencies, which is your Swiss franc and gold. It's kind of like, let's go back to basics. Short politics. I mean, short politics and long gold is just a mantra in of itself. We have this laissez-faire economic regime is behind us. We've got hot, cold economic wars on the rise. Nationalism is totally in. Globalism is out. Trade policy, stagflation, all of that. That plays into a long gold theme. And then finally, long inflation, and yes, we get this inflation. It's certainly not deflation. It just means prices are going up at a slower rate, and I think people don't really understand that. But long inflation, I think it's very structural. It's supply side driven. It's decarbonization, it's ESG, it's deglobalization. Those are all supply pushes. This reemergence of sort of your big fiscal hand. And ultimately, being long inflation, again, into recession, we're going to get disinflation trends. But I think structurally, you've got to talk about the last 2 decades, which was just out of the ordinary. We're not going back to those low interest rates, QE, negative interest rates again. And your best outcome for that, or best metals expression, is just long, pretty deep liquid assets, because you'll have large pools of capital moving into the space, whether it's real estate, real physical assets. So it's oil, it's copper, it's gold, because those are your sort of larger asset classes which can deal with that capital. And with that, happy to take any questions. Okay. No, I don't. Yep.
Nicky, is de-dollarization much of a conversation amongst clients right now?
Yeah, for sure. I mean, de-dollarization.
Where do they think that could bring gold if we're looking?
It's a conversation whether is it net supportive or how bullish, and how is that playing out in central bank demands? I think that they sort of go hand in hand. Certainly, certain regions that we actively deal with. So on the physical side, you talk about Southeast Asia, especially the Middle East now, with sort of growing geopolitical risks. Look at the States, and it's just another sort of hat or another driver to hold gold, and you're starting to see it on the physical side, where, let's say, when gold hit peaks sort of in 2020 and 2021, the physical was very, very sensitive to high pricing, and they're a lot less insensitive now, because I think that de-dollarization theme is just an added incentive to actually sort of pay up, as you will.